We're T-minus 10, 9, 8, 7, 6, 5. We have to go from ready to start. 2, 1, 0. Booster ignition and liftoff.
The growth of the cryptocurrencies can only be described as an explosion, launch of a new era. And if we do not pay attention, industry after industry may change forever without us realizing it. Cryptocurrencies are coming, and they're coming in hot. Hi, this is Sam Ghosh, and let's talk about cryptocurrencies and the future of the banking industry. But first, a disclaimer. This media or any derivative of this media should not be construed as investment advice. This is the first part of this series, and in this part we are going to talk about crypto economics, which comprises of rise of cryptocurrencies, crypto as currencies, and cryptocurrencies as an asset class. Before we delve into other matters, let us take some time to understand the growth of the cryptocurrency ecosystem. The market cap of the cryptocurrency ecosystem, which comprises of more than 10,000 tokens and coins, stands at more than $1.7 trillion US dollars, growing at more than 500% year on year. At an all-time high on 12th May 2021, total market capital of all cryptocurrencies was more than 2.5 trillion US dollars. Cryptocurrencies are traded in more than 380 exchanges around the world. This year witnessed the daily trading volume for cryptocurrencies reaching more than 8 trillion US dollars in one day. Bitcoin is the most prominent token with more than 40% market share, followed by Ethereum with around 20% market share, then Tether, Binance Coin, Cardano, Dogecoin, XRP, etc. The market cap of Bitcoin is currently at more than 750 billion US dollars, growing at more than 300% annually. At an all-time high in April 2021, the market cap of BTC, that is Bitcoin, reached 1.2 trillion US dollars, around 130 times from 5 years ago. Price of one Bitcoin or BTC grew around 60 times in last 5 years. Compound annual growth rate of around 130%, that is more than 3 times that the growth rate of Apple or Amazon stocks. At an all-time high, one BTC or Bitcoin was at more than 64,000 US dollars, around 100 times from 5 years ago. We understand the growth, but what is the utility of Bitcoin or any other cryptocurrency? The first use is as a currency. So what makes cryptocurrencies? Well, currencies. First, let us understand what is a currency. In simple words, currency is a medium of exchange for goods and services. A currency represents purchasing power, giving the ability to buy goods and services in exchange. Does that mean any asset can be currency? If we have some gold, we should be able to find people who would be willing to exchange goods and services for the gold. So does that mean the gold becomes currency? Not really. Currency needs to have certain qualities. And these qualities are durability, portability, divisibility, uniformity, scarcity, and acceptability. So let's take some time to understand these factors. First, durability. An ideal currency should be in existence forever. Physical currencies have some limitations in this respect. A dollar bill, while sturdy, can still be torn, burned, or otherwise rendered unusable. Then, portability. easily transportable and transferable. A currency to be successful needs to be transferred, as it is the primary role of a currency to be exchanged for goods and services. Then divisibility can be easily divided into smaller units without any loss of value. For example, most currencies are divisible to 1/100th of the currency. Then uniformity. All units of a currency of the same denomination need to be interchangeable. All units of dollars are of equal value. Then scarcity. To retain value, currencies need to be of limited supply, and supply of the currency need to be monitored. Traditional currencies control the supply by only allowing the central banks to mint new currency units. Then acceptability. Currencies need to be widely accepted for exchange of goods and services. Value of a currency is tied to this. There are different kinds of acceptability. What can we get in exchange for the currency? Where can we exchange the currency? It is geography, online, offline, etc. And how much goods and services we can get in exchange of the currency. So the effectiveness of the currency depends on these factors. So how effective cryptocurrencies are? Let us first start with durability. Unlike physical currencies, digital currencies are not susceptible to physical damage. Apart from that, blockchain makes cryptocurrencies far more durable, as the transfer history of cryptocurrencies from the issuers, who are also called miners, to the current holder remain in the blockchain. The blockchain is a distributed database. Now let's talk about portability. Crypto exchanges such as Binance and Coinbase are enabling the portability of cryptocurrencies. At the same time, restrictions on crypto trading in some countries are limiting the portability. For example, Indian crypto exchange WajirX is facing many legal restrictions from the Indian government. Now let's talk about divisibility. Bitcoin is divisible up to 8 decimal points. The smallest unit equal to 0.0000001 Bitcoin is called a Satoshi after the pseudonymous developer behind the cryptocurrency. So 1 Bitcoin is far more divisible than fiat currencies such as the US dollar. Now let's talk about uniformity. Bitcoins and other cryptocurrencies are fungible tokens. That is, all Bitcoins are of the same value. Just a mention, NFTs are based on non-fungible tokens. That is, the value varies from one token to another. Now scarcity. Unlike fiat money, which can be minted without any limit, lowering purchasing power for the currency units, cryptocurrencies have limited supply by design. For example, there can be only up to 21 million bitcoins minted or mined. Apart from that, mining, which is the process through which new crypto coins come into existence, is an energy-intensive process, further limiting the supply of cryptocurrencies. Now let's talk about acceptability. On 10th June 2021, El Salvador, a country in Central America, made Bitcoin a legal tender. Previously, Tesla started accepting Bitcoins as payments for their cards before reversing the decision. The fact is, cryptocurrencies are gaining acceptability, but rather slowly and not without reversals and roadblocks. But cryptocurrencies are already popular as investments. The reason is simple. They offer unbelievable growth prospects. In last 5 years, Bitcoin prices grew at a compound rate nearing astounding 130% compared to around 40% for Apple and Amazon shares. But that is not without risk. Bitcoin is highly volatile. The volatility of annual return of Bitcoin for the last 5 years is nearly 150%. Compare that with around 35% of Apple and Amazon stocks. Yes, investment in cryptocurrencies is risky. There is no doubt about it. But the bigger question is, do the investors get compensated for the extra risk? Data shows that at least in the case of Bitcoin, investors do get compensated for the extra risk taken. The Sharpe ratio, which signifies the excess return for excess risk from an investment, is healthy for Bitcoin. A number higher than 1 is considered healthy. This means that although Bitcoin is risky, the returns actually compensate for the risk, at least for now. The primary reason for the volatility of the cryptocurrencies is that the value of the cryptocurrencies are not linked with any economic factor. For example, the value of a stock is linked to the health of the company it represents, and the value of a fiat currency is linked to the economy and the related monetary policy the currency represents. To deal with this, stable coins came into existence, which are pegged, that is benchmarked to some external reference. For example, Tether crypto tokens, USD coins, Binance USD and DAI, etc. are pegged to US dollars. Another crypto named Qcash aims to mirror the value of the Chinese yuan. Apart from currencies, some tokens such as DGX Gold and Hello Gold are pegged to commodities such as gold. Anyway, we can see that cryptocurrencies seem to offer attractive investment opportunities, and they are attracting capital at a breakneck pace. While Bitcoin prices grew at a compound annual growth rate of around 130% in last 5 years, the 24-hour trading volume for Bitcoin also growing rapidly. Currently, the daily trading volume for top 10 cryptocurrencies by market cap is around 150 billion US dollars. So what do these numbers mean for the financial service firms, especially banks? As Sir John Cunliffe, Deputy Governor of the Bank of England, puts it, these new offerings could draw away so much capital from the current accounts that banks would have difficulty lending. But is it all bad for traditional banking players? We will learn about this in the next part. Goodbye for now. This is Sam Ghosh. Bye bye.